I mean, is this really the economy really going gangbusters?
Well, first of all, I mean, if I had the best earnings I've ever had in the history of the IBM company, I would thank anybody who took credit for that. I mean, let's be honest, at JP Morgan, they did a phenomenal job, and I think their hats off to them. There's no doubt the economic environment is better. The consumer's engaged, and you see that showing up. I believe our colleague knows more about that from an economic perspective than I do. So that's all a positive note. The other thing that's interesting to me was that there's a lot of growth in earnings in the trading, the investment bank, you know, which is an indication of, let's say, smart trading in fiscal policy or monetary policy and those sorts of things, not necessarily a correlation to the economy overall.
So what about the economy, Afsaneh?
I think the interesting thing was also that the trading area contributed a huge amount to the earnings reports this week. And the question is that really an indication about the long-term economic forces, or is that sort of a short-term phenomena related to the issues we had on the repo markets and people trading a lot last year? So in terms of the economy, obviously the economy is doing better in many sectors. The retail sector was very, very strong. And as you could see within the bank's earnings, areas that had to do with consumer and those who do have cards seem to have done a lot better as well.
Well, you can say that it's all about trading, but in fact, it seems like Goldman Sachs wants to become JP Morgan. They want to do less trading and more retail banking. They want to get into markets and things like that. I mean, the banks seem to be going more into traditional banking areas.
Well, I mean, from my point of view, having run a big company and trying to create shareholder value, consistency is more important than volatility. So if you can create a business model with less volatility, I mean, trading operations, as we all know, are market dependent, and you have huge quarters and you have bad quarters, right? So you have a lot of volatility in the earnings, and therefore your PEs aren't, your multiples aren't as large as perhaps if you were consistently delivering earnings growth over time. So I think it makes a lot of sense for a lot of these institutions to begin to diversify their income streams to get a little more consistency within their business models.
What happened to regulation?
Regulation, a lot of it has been taken off, but a lot of it is still in place. So, for example, when we looked again at the earnings reports, we saw Wells Fargo. The issues related to litigation did affect them, like 1.7 billion. Goldman had issues related to regulation. So it certainly has impacted some of the banks, but the ones that were that did really well this week, like Morgan Stanley, like JP Morgan, were actually the ones who did not have a big hit or who post-2008 made a lot of the adjustments. Because the investments that the banks made to deal with the regulatory framework that was put in place post-2008, a lot of them have not removed. It's too expensive should the government change or should regulation come back to put it all right back.
And the other thing, they've made huge investments in technology. I think sometimes when you look at their ratios of expense ratios and cost ratios, I mean, and JP Morgan's a leader in this space, quite honestly, having worked with a lot of these banks, but they've made massive investments in technology, not only in their core operations, but also addressing a lot of the things associated with this digital economy, often referred to as fintech, but nonetheless, they've all invested heavily, and I think they're getting the returns for those investments.
We're just starting earnings season now, and everybody's trying to figure out where are we going with earnings overall. A lot of investors say, well, maybe banks are sort of a bellwether because it's an indication of how the economy's going. When you were at IBM, was there a correlation between how banks did and how you did?
Not necessarily. No, we were more tied. Economic cycles, yes, because we were large and in 170 countries, so capital spending was very important to us. So if you had to correlate, as we would think about our potential for earnings growth and growth, unless we had a product cycle and those kinds of things in technology, which you still see today, it was more around a correlation of capital expenditure because we were tied to that. I mean, the budgets were set along companies' confidence to invest.
I was going to say, in fact, the loans to the industrial sector and manufacturing did go down on behalf of banks. So the correlation may be weaker even today.
Yeah. So I just think that, who knows, we'll see. I'm no longer engaged day-to-day. I retired. I was CEO, 2011 was my last year. But my sense, if you look at tech earnings, which I follow a little more closely, they've been going down. Earnings have been going down. Forget the stock prices. And hopefully there's a sentiment from the analyst community that the fourth quarter earnings in tech bottom. and it begins to come back again in 2020.
Well, what about that, Afsaneh? Because I think 2019 was a story of actually PE multiples really sustaining the value of the market more than the earnings. The earnings were up, but fairly modestly, not nearly as much as the market was. And what can we expect in 2020? Can we expect basically the earnings to catch up?
That is the sense we have right now at this point of the year. And also, it's the indications that CEOs are giving of what it will be like this year. I think that is going to have a huge impact. The only problem with that also is that if there is any deviation from that expectation, that company will probably end up doing a lot less well. So I think this year we will see a much bigger variation between companies within the same sector versus last year where you had, all tech sector go up together and down together.